All right, today we're going to pull back the curtain on international finance. We're talking about how the world's biggest companies manage their money across borders. And let me tell you, it's a massive, high stakes game where trillions of dollars change hands every single day.
So you've got to wonder, right? Why do these huge companies go through all the hassle of setting up shop in dozens of different countries? Dealing with different laws, new cultures, a whole bunch of different currencies. It sounds like a headache. And yeah, the easy answer is to make more money. But trust me, the real story is way, way deeper than that.
See, in the hyper-connected world we live in now, being isolated, well, that's not playing it safe. It's actually the biggest risk you can take. For a lot of these corporations, expanding around the globe isn't just a nice growth opportunity. No, it's literally about survival.
So what's really pushing them out the door? Let's dive into the powerful forces that compel these companies to spread their operations all across the planet. The old school way of thinking was pretty straightforward. It was this idea called comparative advantage. Basically, if France makes great wine and Germany makes great cars, they should just stick to that and trade with each other. The stuff crossed borders, but that was pretty much it. But yeah, that's not how the world works anymore. Not even close. Modern companies, they don't just ship products. They move the whole shebang. We're talking the money, the factories, the workers, the technology. Everything gets packed up and moved to wherever on the planet it makes the most sense.
The real reasons they do this are much more strategic. First, you've got to lock down a stable supply of raw materials. Then, you want to get your products in front of billions of new customers in new markets. And, of course, you're always looking for cheaper, more efficient ways to make things. At the end of the day, it's all about boosting that bottom line.
Okay, so going global sounds great, right? Lots of opportunity. But there's a catch, a big one. This whole global game has a villain, a constant, unpredictable threat that can turn a profitable quarter into a disaster overnight. So let's meet our nemesis, exchange rate risk.
So what exactly is it? Well, in the simplest terms, it's the danger that the money you're expecting to get, or the bills you have to pay, suddenly change in value. Why? All because the value of one currency decided to do a little dance against another. And this risk? It comes in three main flavors. First up, we've got transaction risk. This one's the easiest to wrap your head around. You make a deal and agree on a price today, but the actual payment isn't going to happen for a few weeks or months. In that time gap, the currency values can shift, and that can totally change the final value of your deal. And just look at how easy it is to get burned. A US company sells something to a German company for 100,000 euros. They're expecting that to be about 110,000 US dollars. But the euro's value takes a little dip before that payment comes through. And just like that, $5,000 of profit just vanished into thin air. All right, the second type is translation risk. Now, this one's a little different. It's more of an accounting headache, an on-paper problem. When a massive global company has to report its earnings, it has to take all the financial statements from its operations all over the world and translate them all back into its one home currency, like US dollars. And here's where it gets kind of wild. So a US parent company has a subsidiary in France with assets worth 10 million euros. At the start of the year, that converts to $11 million on the books. Great. But then the euro weakens. The physical assets in France haven't changed at all. But now, when you translate that value back to dollars, they're only worth 10.2 million. The company just took an $800,000 hit on paper. Finally, we've got the big one, economic risk. This isn't about one single deal or one accounting report. This is about the long game. It's how these currency swings can fundamentally change a company's entire business strategy, its ability to compete, and its profitability for years to come. Think about how this affects huge, multi-billion-dollar decisions. A Japanese car company builds a massive factory in the US. When the yen is strong, this is a brilliant move because the profits they make in dollars will convert back into a ton of yen. But what if, over the next 10 years, the yen gets weaker? Well, now those same dollar profits are worth way less back home. Suddenly, that huge investment in the US plant doesn't look nearly as profitable. So if currency risk is the bad guy, where's the battlefield? Well, that takes us to the global financial arena. This is where companies go to fight back. Welcome to the foreign exchange market, or Forex for short. And no, this isn't a building you can visit on Wall Street. It's a gigantic global network of banks and brokers that is always on, 24/7. Its whole job is to keep money flowing, to finance trade, and this is the key part for us, to give companies the weapons they need to fight that currency risk.
Now, within this system, you basically have two main playing fields. The onshore market, think of that as playing a home game. You're in a specific country using their currency and following all their rules. Then you have the offshore market, which is more like playing on neutral ground. It has fewer regulations, which gives companies more flexibility. For instance, a Korean company could issue a US dollar bond in London, completely outside of direct US oversight. And that brings us to the playbook. How do companies actually use these markets to protect themselves? It's time to talk about taming the beast.
The number one weapon in the arsenal is called hedging. And honestly, the best way to think about it is like insurance. You pay a small known price today to protect yourself from a huge, unexpected, potentially catastrophic loss tomorrow. You're essentially treating a wild, unpredictable risk for a small, predictable cost. You're buying certainty.
One of the most common ways to do this is with a forward contract. Here's how simple it is. Today, a company agrees to exchange euros for dollars in 90 days at a specific rate they lock in right now. For the next 3 months, the live currency market can go completely haywire. Up, down, sideways, it doesn't matter one bit. Because on day 90, they make the trade at the exact rate they agreed to. No surprises, risk, gone.
Okay, so we've seen the risks and the tools companies use to manage them. But let's zoom out. Why should you or I care about any of this complex financial stuff? What's in it for us?
Just look at this chart. This really shows the power of going global. If you put all your investment eggs in one basket, say US stocks only, your portfolio carries about a 27% risk level. But if you spread that same money out across different international markets, look at that. The risk plummets to under 12%. You've literally cut your risk by more than half.
And this isn't just about Wall Street. When companies can manage their currency risk well, it actually creates a more stable global economy for everyone. It means they can borrow money more cheaply to grow and innovate, and makes our own retirement funds safer. And that stability can even trickle all the way down to us in the form of lower prices for the stuff we buy every day.
So it all comes full circle, doesn't it? Companies are pushed to go global just to survive, but to do that, they have to become masters of this incredibly complex financial game, which kind of leaves you with one big question to chew on. In a world that's this interconnected, is trying to play it safe by staying home actually the biggest gamble you can take?